What's up, everybody? Michael Silva here. Something is about to give. In today's Stock Market Brief Show, we're going to talk about the purple magic line. We're going to talk about some other big expected moves from a weekly perspective and some overall stuff that I see leading into the big reports coming tomorrow, 1 hour before the market opens. All that and more on today's Stock Market Brief Show. Let's go ahead and get into it. All right, everybody, welcome back. So yes, tomorrow, 1 hour before the market opens up, we're going to be getting that inflation data. The following day, we get the PPI data. And we got to just look at the overall market, what it's doing, what it's telling us right now leading into this report, because it is sitting at some very interesting levels overall, and that's what we're going to really be discussing on today's episode. So first and foremost, I want you to pay attention to the purple line. The purple line is the 5-day moving average on the 15-minute time frame, i.e. 130 is the simple moving average parameters that we're using. We talked about that on yesterday's video, and clearly you can see it's in a declining phase. And why we say it's magic as well, it really has been holding as a level of support prior, and then when we got price action well beneath it and it started declining, you can see that's been holding as a level of resistance, including yesterday and today as well. We talk about stage analysis, how you can go through stage 1 accumulation, stage 2 markup, stage 3 distribution, then you get the downtrend in stage 1. And remember, these have like little trends within it. So if you're looking at this from a longer term perspective, maybe a weekly time frame where you use a 30-week moving average or a 40-week moving average, that would be stage 1 when it goes sideways, stage 2 when it comes up, and so forth. But in between that, you can use very small intra-trends like so to play the markets. And as it stands right now, when you look at something like the daily time frame, well, we're in an overall bigger uptrend from the start of the year. We have a series of higher highs and higher lows, but when you look at it from a very smaller perspective, we have that declining 5-day moving average, and it's clearly holding as a level of resistance. So if I just remove and show you more of this purple line, what you'll see here is it goes through phases, right? It goes through decline phase, boom, right? So price action probably came up here, came down, right? And then it started base out, started leveling out, which is more of an accumulation phase. So you have decline, which is stage 4, stage 1, stage 2. This could have been a stage 3, but really this was just a base before continuing its markup phase. And now we're sitting currently, like we already stated, in that decline phase over here. And you can see if I just overlay the price action as it stands. So yes, as the price action is, putting in a series of lower highs and lower lows, we're under that declining 5-day moving average still. Okay, so we have to proceed with, obviously, caution. Now, there is another thing that the market is telling us right here, and you can look by the price action. It is contracting, right? So markets move between expansion and contraction. What you see here is a strong move, right? But then we bounced up, boom, strong move, okay? What you'll notice here is when I draw this out, what are you seeing? You're actually seeing the highs and lows compressing. This is coiling up into potentially a wedge formation, right? So it's potentially wedging. Bearish falling wedges could typically be bullish formations if they break out. We're still holding that 445, and remember, gap fills can potentially act as support. And while this is heading down, we also have that positive divergence forming there too as well. This is all taking place, though, below a declining 5-day moving average. So in order to be bullish, give it some time. You want to be back above this, and you want this to start flattening out and turning back up. That's what you want if you are bullish, and we're just not there yet. If we take a look at the daily expected moves, what happened today? Well, got outside of it, almost hit a 2 sigma daily move, but not quite. They were about $1 off, and then it came back up into kind of where the start of the day was, almost getting positive on the day. That's when we tagged the 5-day declining moving average, and then we sold off, for whatever reason why we sold off. I'm not too sure. Some people believe that it could be a CPI data leak, but the bond market didn't really respond, which, kind of negates that. Now, like I said, we're below a 5-day moving average, but we're also below the month-to-date anchored VWAP, week-to-date anchored VWAP, and the quarter-to-date anchored VWAP as it stands. So what does that mean? It means, well, we have a declining 5-day moving average. We're below all these key levels. It is short-term bearish, right? That's just what it is as it stands. If we start reclaiming those levels, it could be short-term bullish, but with caution. Why? Well, because price would get above the 5-day moving average, but it needs to flatten out and start to incline, okay? All right, so like I said, on the daily time frame, series of higher highs and higher lows, getting back below that quarter-to-date anchored VWAP. You can see yesterday and then today had some follow-through, so to be more bullish, you'd obviously want to reclaim that. This could be a period of consolidation of some sort where we go sideways. I put in the last quarter to date anchored VWAP, and the reason why, this was back in April, so January, February, March, April, May, June, right? That's the second quarter. And you could see when we did that, you saw it just chop around multiple times before eventually breaking above it and then going on its run. This is why it's important to note when we're back above those levels, it could turn into a bullish style move, which we're just not there as it stands. As far as downside goes on ES, I'm still looking at this big level here. It's been here for over a week now. It's just a lot of contracts. It's been sitting there. I wonder if it's going to get removed or pulled tomorrow, or if that liquidity is going to actually get absorbed, depending on how the market responds to that key CPI report. Now, if we take a look at the daily expected moves for this 4455, so we could go ahead and just draw a line right over here. 4455 is right about this area. Okay, so that's what the daily expected move is projecting as far as implied volatility goes, and 4531, which is just about right over here, just right kind of like where this little swing high was over here, okay? Now, we've been seeing 2 sigma moves, so this is, $38 move is a pretty sizable move heading into the report. So obviously the market's saying that there is going to be more volatility, so we'll see here if it can actually extend outside of those daily expected moves, which we've been seeing now for a couple of days. If we update you on the SPY daily expected moves, 449.66 to the upside, that brings us right to the quarter to date anchored VWAP, okay, and then also the month to date anchored VWAP in confluence with that daily expected move. And to the downside, 441.84, that is the lower daily expected move, and then below that is our weekly expected move, which, remember, typically you see these things tagged within the week. We talked about that last week, and then we tagged it. We have 2 more trading days left, and where are we for the week, right? People are saying it's so bearish, it's so bearish. Okay, well, really, we're just consolidating right here. That's all that's going on. Short term, it's bearish, right? But as it stands, it's just volatile. It's a lot of chop. Because if I look where the week closed last week, and I just draw a line straight across, we're basically, one 15-minute candle, not even, but, from where we started the week. So we're going to potentially break from here as price action is coiling. When we talked about seasonality yesterday, which, has, kind of a sideways to potentially down type of day, was the 7th trading day. Now going into the 8th, into the 9th trading day, this is actually, you see some type of trend type of movement here going as far as seasonality goes. So that's going to be interesting to see if this plays out. Also to note, though, if you look at like S&P 500 seasonality, and we'll look at the blue line, which is pre-election years. The purple line is 2023, so this line is 2023. The blue line is the first term of pre-election years, and you can typically see where we top out, right? And then it starts sinking down. Well, it kind of followed that, and it's sinking down right into around this area, which tells us that, hey, we could be potentially in for a period where we start to see the market move, okay? That's not a guarantee, because it is obviously just seasonality, but it's something to watch. As far as season earnings go, we still have Baba in the morning, a couple other ones. Disney reported after the bell today. It tagged its upper earnings expected move. That's why we talk about expected move. The markets, when they get it right, they can get it right. So it's important to know these levels, not to predict where the market's going to go or, whatever. It's helping you adjust for risk going into the trading session, okay? If we take a look at the heat map, it was the big mega cap names that really got kind of busted up today. So is the AI bubble kind of decelerating here? It's a potential. But overall, even with a 4% move here, Tesla was a 3% down move. I wanted to point out this chart here, and it's showing you, the big mega caps, some big mega cap names. Majority of them are big mega cap names. You got Apple, Microsoft, Google, Amazon. And then I wanted to point out over here. So on my Patreon group, I show the weekly expected moves, before the start of the week starts off, and it basically says, hey, Apple, the options market is saying we'll probably see about a $5.29 expected move that's plus or minus, $9 for Microsoft, $3 for Google, and so forth down the list. Okay, and then it gives you the upper levels, the lower levels, and then I just add this on here this is not something that I typically share, but I just wanted to get a good idea is, okay, we saw some big red days, the market's moving down, but is the market doing anything outside of the norm? Is it getting outside of that one standard deviation? And I'll tell you right now, no, that's not the case. It's actually doing everything that the market said it was going to be doing for the most part, right? You can see it's yellow. What does the yellow mean? It means it's within the upper and lower, so it's within this range. So if I look at 178.19 for Apple, The lower level is at 176. Well, 178 is above that, and it's also below 187. So when it's yellow, it's telling us that it's all within the expected moves. You might be looking at this one over here, the red one. That is NVIDIA. So NVIDIA did get cracked a little bit today, but when you look at it, 425.54, and the lower level is 426, it's a $430 product basically, and we're only $1 outside of it. So leading into the CPI report, we're at the lower level here for a market moving, type of name or a heavy mega cap name, and we're at some lower levels too. For example, like Microsoft, right? 322, the lower level is 318. So we've already made these moves to the downside leading into the report, which what does that mean? It could mean that the market's forward looking and it's pricing in what the report's going to be. So when the news comes out, if potentially we see the uptick in inflation, we'll see if the market continues to sell off, or if the market responds in some sort of a bounce. If I take a look at the price of NVIDIA, we are now below that 50-day moving average. So you'd want to see this back within this range for this consolidation to continue on, but it is starting to kind of break down right through it. So just a move right back in it. We'd still be ponging around within that tight range. One to watch, though, is semiconductors, right? SMCI got cracked. That's a big name that went on just a monster run. But we're in a bull channel, right, for SMH. And we've been talking about this trend, right? This little tiny trend within the bigger trend. And it broke down. We said watch for the potential midline to get touched, or potentially to come back down and test the lower trend line. Well, we cracked it, and now we're floating right around that middle line. So to be more bullish, you'd want to see this obviously uptick, but it did crack that trend line, so I do want to call that out. Now, leading into this report, I find this to be quite interesting. The S&P 500, from a monthly perspective, check this out. So oh man, it's so bearish. It's like we're just having a monthly inside candle. That's all we're doing right now. So yeah, we're down 2.64% on the month, but we're still trading within last month's candle. And on top of that, we're still within the monthly expected move. So if we start getting outside of it, okay, then start looking at the monthly 5 EMA. The monthly 5 EMA is at 4384 for the SPX right now, okay? Now the lower line, this solid line, that's the monthly expected move. Ain't no one ever talking about these, okay? This is what the stock market, or with the financial markets, right? The S&P 500 options traders, that's what they price in as far as forward-looking implied volatility. This is the expected move of risk. And remember, 68% of the time, it finishes within that, okay, which is a higher probability. And where are we at now leading into a big report, a potential trigger to see some more volatility? Well, we're right about at the lower edge. So, 4.4s, right, is the lower line right there. And we closed at 4.467. So we're like 20 points off from the lower expected move there, okay? Also to note, Qs also is right there tagging just about the lower. We were about a couple of dollars from it. We're tagging the lower monthly expected move, and you can see we're still above an inclining 5-day moving average as it stands right now, 5 monthly period moving average, and it's still within a inside trading candle as we've been on a monster run. So to see consolidation right now, it's not too crazy to see this. Now, if we start getting cracked more, pay attention to the monthly 5 EMA, and that's right about 357.50. If you take a look at IWM, also just trading with inside the last month trading candle, it's above a monthly 5 EMA. We had that PMO crossover. We are back into bear market territory, surprisingly enough. So if you measure from here, 20% down, that's where that red shaded area starts. And anything below this is obviously 20% or greater to the downside from the high. So technically, we're back in bear market territory for the IWM. So if we start bouncing back out of it, we'd be back outside of bear market territory there. Let's take a look really quick at HYG over SPY. We talked about that one just the other day, and how it sometimes gives us short-term pivots in the market by looking for divergences. One of them that we talked about yesterday was you had this high and a lower high, where you had a high and a higher high. HYG, right? Smart money is, you got to be a smart trader to trade the bond market, versus they call this the dumb money, right? The equity market. And you can see that divergence played out to the downside. But as it stands, what you'll notice is we have price action wedging here. We also have price action wedging right here. Okay, and this is important to note because HYG, the quote unquote smart money, is going up. quote unquote the dumb money is going down. So one of these are line. And what will really prove my point here is not me just saying that, it'll be me showing you, let me fix this. What just happened? It'll be showing you the correlation, okay? So we're looking at just a 5-day correlation of this chart. So you have smart money up top, dumb money, but now I wanted to correlate the two to see, okay, well, is it usually a positive correlation or is it not? Well, anything above this red line means that the 5-day correlation is in positive state. So as you can see, where do we spend most of our time? We spend most of our time in a positive correlated state. So what does that mean for traders and whatever? It means that something here is lying. Either HYG shouldn't be going up and the bond market's going to get it wrong, and that's going to come to the downside with the SPY, or the SPY is not in the right position and we're going to start to see this catch back up. One thing is for sure, we don't know the answer there, but one thing is for sure, history suggests that the correlated state being negative does not stand there for a long time, just looking back 5 or 6 months. So it does not stay there long, and it gets back into a correlated state very fast. It doesn't stay there long and it snaps back. So that means this correlated state, this 5-day correlation, it's not going to last in this negative state for much longer, okay? If you guys want to go ahead and screenshot this, I'm going to once again share the daily expected moves going into tomorrow. These include the 2 sigma levels, and also this is what I just give to my Patreon and Discord group every day because of the volatility. I just wanted to share them here for you. That's all I got for on today's episode, everybody. See you later.